which I hesitate to say right now in this market environment, but debt can be a very valuable tool in many market environments. I want to say like an expert category of investing, but the reality is if we're dealing with high inflation, which we are, then the reality is you're inflating your way out of debt, right?
Welcome, everybody. I'm your host, Nathan Loy. And today, on today's episode, we have none other than Nick Deangelo, the president of Saint Investment. So welcome, Nick.
Yeah, I appreciate it, Nathan. Glad to be here and great catching up with you a little bit beforehand.
Yeah, no, this is going to be an exciting episode. I'm ready for it. So, before we dive in today's topic of kind of the current economic climate, the decade, potential decade worth long of inflation that lies ahead of us, and different kind of investments that work well during inflationary times and ones that might not work as well. Can you tell us, your story, how you got to where you got to be and kind of how your group got started?
Absolutely. So there's kind of two stories on the origin side. The first is that I grew up around a family of entrepreneurs. So they're immigrants. They came to this country, and it was, an Italian family that just had this very entrepreneurial spirit that was very clear about move forward. We're in the country of opportunity. You take advantage of that and work hard, and you can be successful. And so while everybody worked a lot of hours, and that was, and hard work was very respected in my family, there was a very clear direction to kids in the next generation that there was no ceiling in the US, that you could do anything and achieve anything. So that was something that was very near and dear to my heart. So the more I read investment books from an early age, money management, real estate was just the shining star. It really was. And so there was nothing else that I really wanted to do. I always knew that I'd be working with companies and I'd be starting companies along the way. Just it was kind of part of the gig for a family of immigrants that had that mentality. But real estate was always the end goal, always. So where did that lead me? It led me to get towards real estate investors that were much more successful than me from a very early age. So I started even in high school. I helped some friends and family that I just knew were successful. I wanted to learn from, and I helped them with real estate marketing early on. So I got my foot slightly in the door by doing that. And then, kept in touch with them, learned from them over the years. And then it really started hitting the ground running when I was getting out of college in the wake of the 2008 financial crisis. And I knew these people had money. I knew that I was surrounded by people that had an interest in real estate or even a light investment in real estate. But there were more deals than dollars at that time. Right. So there was this huge market discrepancy where there were deals going for below replacement costs. Right. We don't even hear that term anymore often. Right. Below replacement costs. And there was money that was just too scared to do anything about it. So it was a capital advantage point. The buyer was in a significant advantage. So we took advantage of it, and I pooled some capital. We were buying millions and millions at trustee sales, which was the biggest opportunity at that time. We gravitated towards commercial, so a lot of retail, a lot of office, crazy, a little bit of industrial at that time. And then fast forward, we had all these properties and we had no asset management, right? So we didn't know what to do with all these properties. So I kind of built out the asset management arm with a couple of my partners. And then we woke up, and in 2015, we started taking outside investor capital because we now had this long track record of doing this. So that's really the genesis from the real estate side. But on the entrepreneurial side, I was running companies at the same time. So I'd like to say that real estate was like the earliest dollars I ever made. The reality is I had started and built several companies over the years, and it reached a point where real estate was always the interest, that was always the goal, but these companies were doing great, right? And that's a really good thing, unless you've been on the entrepreneurial side and you understand that sometimes you don't build a company in the way that's the most strategic for, let's say, your health or your mental health or your relationships, et cetera, et cetera. So I reached a point where I was putting in, 100+ hour weeks every single week, right? And these companies were doing great and they were, very profitable, but they were lumpy. So we were making a ton of money one month, and then the next month we were having huge issues where it was not an issue with the company. It was just a cash flow management perspective. And I sat down, and it was like, these companies were very successful. And I went through the numbers, and my health was significantly impacted. I was I was not exercising. I was eating like crap. I was eating in my car wherever I could. In the office, I was scarfing down whatever. My personal relationships were suffering. Wasn't close with family, with friends. Hadn't talked to many people in years. My romantic relationship was one of the few things I had that was falling apart. And then at the end of the day, I realized, this roller coaster of finances I was on, with some companies being very seasonal, was just difficult. And I sat down. I said, I can't do this. I need to analyze my finances. What I found out was that after years of raising money in my own businesses and then shoveling that freaking money into real estate, right? I was a multimillionaire driving a Prius, which I still have today. It's my favorite car in the world. And I was just putting every single dollar from the companies into real estate. And I woke up and about 80% of my income was coming from real estate at that point. And only 20% was coming from these companies I was pouring hundreds of hours into. And I was like, well, what am I doing? What if I put 100% of our focus into real estate? So that's when we positioned the multiple companies. We sold those. They're in multiple states. And that's when the real estate side really took off. We started taking outside investment. We started bringing in other investors. And really, it was what I enjoyed doing. So that's kind of a long and the short of both sides of that. It was kind of my aha moment where I knew the biggest value I could add to people was to bring them into the investment fold and show them what we were doing successfully. And also for me to focus, straight on with our amazing team and just keep going ahead on that.
Yeah, that's amazing. That's amazing. There's so much to unpack there. So, I first want to start off with the Pareto principle, right? That kind of like that 80-20 rule where it's, you can spend 100 plus hours on a company, but it's really what's really driving the needle forward the most. So what kind of businesses were they? Were they real estate businesses? Were they marketing? Was it something completely different?
Yeah, so it was a number of different businesses that all overlap. So there's a principle in entrepreneurship or in small business, especially. These were all small businesses doing at their peak around $1 million a month with really high margins. So that's healthy, but it's also not a massive business. It's not a multinational or something. So They ranged from anywhere from emerging industries. So we did things like cannabis. We did things like working with new legislation with different cities where we were buying retail centers and rezoning them. So a lot of entitlement heavy stuff, a lot of things where we were buying properties and upgrading them for electrical distribution, things that were like really hands-on industries. Finance, we had an ATM company. So we weren't focusing. We were just adding on horizontal businesses rather than going really vertical on any one thing. Yep. So when I understood the value on the real estate side of just really going all in on the real estate piece or on any one industry, it really became apparent, the Pareto principle, right? Where you can be a master of one thing and get paid exponentially, add exponential value for being such a high level value in that place, rather than being a wishy-washy dabbler in a bunch of different things. So we just cleared the deck and just said, real estate, we're doing good. It's a natural strength. We need to move ahead on that.
Yep. And I love that you took a look at your kind of financial health too, because when you have so many businesses and you have all this income coming in, it's easy to get distracted by, the Ferraris that you could have bought, or the houses that you could have bought. But to really kind of take a financial kind of pulse on what is really driving the most income, where am I kind of bleeding my expenses? So, for those high income earners, doctors, attorneys, lawyers, can you walk us through what that methodology was of, all right, you have this income coming in, but how did you actually analyze that it was real estate that was kind of the driving force of all the income that was coming in?
Absolutely. Yeah. So I'm a huge fan. Many of my mentors growing up, extremely wealthy, most of them had an either immigrant or first generation immigrant mentality. So they simplified investing and simplified, really big life moral things in amazing ways. And so one of them was that really helped me was that there was no such thing as earned income, right? Every dollar that you brought in was only fuel for your investments. That's how I lived. So if I made, hundreds of thousands a year, I didn't eat off that. I refused to spend that on good, healthy living, happy living, going skydiving and living on yachts. Like I wasn't going to do that with that money, right? That money didn't count until it was paying me back from investments, right? So only the second round of income that I received, meaning I earned that income once, but I immediately invested that into investments. By the time I received that again from the investments, I was like, I'm really proud of this dollar. I'm proud of this dollar, not the first dollar. That's just the dollar that goes into the bank account that now is going to find an investment home. That second dollar, that second time around. So I really stuck close to that. Again, I didn't have kids. I was living a very efficient, very financially efficient life. Now I have a bunch of freaking kids. I have a big family and all that. But at that time, I spent nothing. I invested everything. And that grew exponentially for me in a big way.
Yep. I think it goes back to kind of that principle of being diligent, of being patient, right? Because most of the time when you see, money in your bank account, the kind of natural reaction of most, called the standard American, is to go out and buy something new with it or to go and celebrate, right? But those that are really focused on building wealth at least on a massive scale, fuel that into investments, then take the profits from the investments to live off of and to kind of build that cash flow. But at the very least, it's not, sitting in your bank account earning 0.1% on your money, right?
Absolutely.
So you can snowball it a lot faster, which is great. Awesome. So, yeah, I mean, you've been through so many different economic climates with, creating businesses, exiting businesses, picking up real estate, disposing of real estate. Kind of give us your view of the current economic climate, what's caused, the record inflation that we have seen in the past year and a half, and then why you think that's going to sustain itself for, potentially another decade.
Yeah, I mean, so I'm admittedly a huge dork, right? So I go all the way down the rabbit hole on economic issues and really geopolitical issues because in a globalized world, everything intertwines in a big way, right? Oh my gosh. So inflation, here we are. The good news is inflation's been going down, but I don't have a huge bet on that. I don't think that's a forever. I don't think inflation was a blip on the radar, and I've been spending a lot of time on this. So, if you look back at what was the summer of 2022, inflation hit 9% year over year, right? 9%, which we haven't heard in, decades, right? I think it was the 70s, the last time we were throwing around crazy numbers like that. And people were, scared, rightfully so. But if you unpacked that and you really dug in, the reality was it was mostly COVID, right? Like if you really peel back the layers, it takes a supply chain in a global environment like we're in about 18 months to adapt to major changes in the environment and in the consumer preference. So if people were working from home all of a sudden, then office was going down. So then are they buying computers at home or are they traveling less? Are they buying less cars and are they buying more playground equipment to get their kids outside so that they could focus on? Those are all trends in the consumer markets that are up and down. And then by the time the companies figure this out, then they have to retool their their manufacturing and their sales. That all takes about 18 months to even out. So the peak of that was summer 2022, right around that 9%. So the good news is I think we're well out of the COVID inflationary environment, and that will be ticking down from COVID. Mm-hmm. The issue though, is that this is a storm brewing from many factors. And so inflation's a complex issue. It's not ever one thing, most common. Where we're at today is, man, I mean, I could drill. We literally spent a 2-hour webinar on this. So I'm going to send you the link. If your listeners want to check this out, you have a smart audience. I know you have a very intelligent audience. They can really drill down on this. We go crazy depth. But long story short, there's there's international. You look at China, the cost of goods, the cost of production in China is up 15x since the early 2000s. So that hits Americans as the biggest consumer of Chinese goods. That hits our wallet on that side. More concerning to me is the domestic issues. And the biggest of those are the baby boomer generation aging out of the workforce. So you deal with the biggest and the wealthiest generation of all time, the baby boomers, right? They killed it. They were huge. They made a huge impact. The world was, an American world in post-World War II, and they made the stamp on the world at that time. And in the wake of that, now eventually they want to retire after long, successful, big careers. They want to retire. But replacing the baby boomers is the smallest generation we've ever had, Gen Z. And also, Gen Z is the lowest labor participation rate we've ever had. So the boomers, big generation, very involved, everybody, very high labor participation. Gen Z's less so labor participation. We'll see where that goes. That might be an early trend. They're also the most educated generation. So maybe their education is lopsiding their work, their labor participation. But what that does is that causes a disruption in labor rates pretty significantly when you have a huge labor force that's contracting. So that causes labor inflation because each job then pays more. So then companies incur more costs, right? And they have more costs. So then they charge that to consumers. And then cost of living increases. So then people need higher wages to, you know what I mean? So this becomes a cycle where we don't know, where we're in uncharted territory as in most categories, the leader of the world in GDP in many categories. We don't know where this lands. China doesn't know where this lands, which is our only competitor on the GDP side, because they're dealing with their own demographic issues, right? So we're in uncharted territory. Really, why I say a decade of inflation ahead is because the millennial generation, which is the next large generation to replace the baby boomers, doesn't fully start hitting their earning potential stride, which is like late 40s, early 50s, for another decade. So at that point in time, kids start moving out of the house slowly. Expenses drop considerably with that. Also, you're at peak earning potential of your career. You kind of been around the block a little bit in terms of your industry. So your earning goes up. Millennials really step in that role in about a decade. So while we enjoyed, 3% loans for a huge period of time and capital was really cheap and returns were amazing and there's a lot of benefits, I think we're on the other end of that, where the pendulum's swinging the other direction, where we're probably going to be dealing with higher rates for a period of time. Returns might be compressed in many areas for a lot of rebalancing of those industries. So that's what we see. And again, it's a 2-hour discussion that we had, but that's kind of the highlights of what we talked about. Yeah,
I love that. Would love to see that webinar too, because it sounds like I'm the same with you. I nerd out over going into a deep dive into a subject matter, and if I can learn anything and everything there is to learn about it, I'll dive in as much as I can. So,
totally.
And I'm glad you kind of focus on the kind of demographic shifts that are impacting inflation, because a lot of time, again, for the standard American, when they see inflation, they see prices rising, the easiest thing to do is kind of shake your fist at the upper man and say, hey, why is my gas 2 times more expensive? Why are my grocery bills going now triple digits, right? So I love that you're focusing on the people portion of it, because all really inflation is that supply and demand imbalance, right? And seeing inflation is actually not necessarily always a terrible thing, right? To see the cost of goods get more expensive means that there's demand for those goods, right? The alternative is you have, I'm not going to name some countries, but there's countries where, the price of their dollar, so to speak, has been devalued year after year, and prices, yes, goods have been getting, less expensive, but it's not a great thing when it comes to housing prices and for the cost of goods, where I'd rather be honestly in inflationary times than deflationary times if they're going to be kind of long lasting, right? As much as an impact is on the bottom line of most kind of Americans' bottom line pockets. So with that, how have you seen inflation really impact real estate specifically? And do you think it's going to, shift the way you've been doing business over the next few years? Because I love your kind of origin story, being scrappy, being kind of, an immigrant. I think now is really the time where you really have to, dig deep on honing in operations, getting creative, getting kind of scrappy, while kind of the rest of the world might see it as kind of being on fire.
Yeah, so there's so much there, and you made so many good points. So first off, let me compliment you guys. Viking, you guys crush it. So you guys are in the exact place that we're in a space saying, look, guys, if there's inflation, you want to be on the right side of it, making the right moves, right? So I know you guys are doing a lot of great things for your investors. We're trying to do the same. So all that to be said is, inflationary, deflationary, complicated environments. It's important to understand now more than ever with inflation at around 5% today that they'll admit to us, right? There's a lot of reasons why maybe they shouldn't report that accurate number that benefits the government and, a lot of other things. But let's say it's 5% today, right? That actually puts the investor in a difficult position, okay? Because 2%, 1.5%, the numbers that were in the far distant past, right? Those numbers, if you're sitting with hundreds of thousands in the bank, I know you have a wealthy audience, right? They're successful individuals. You guys have built that and made sure to always speak to their concerns and what they're dealing with. So this is right down the fairway of that discussion. If you're wealthy and you're sitting in cash at 1.5% to 2% inflation, it's not the end of the world. It's not great. It kind of feels crappy, but what feels really bad is when you're at 5 to 9% inflation sitting with your cash in the bank, because you're watching your money dry up as far as your purchasing power on that. So where that puts the investor today is in a tough position because they actually have to invest. At 1.5%, the pain's not that big. At 8% or 6%, that is a lot of pain to watch your money eroding. So if you're a busy, successful professional and you're making good money, you can't afford to sit in cash. Now, a lot of like the mainstream finance feedback that you get is, well, no worries, just put your money in a high yield savings account at 3, 4, even 5%. But the reality is that either doesn't beat inflation or it barely beats inflation. So you're actually in the same boat. So now you're trying to balance inflation on one side, and then the other rock in the hard place is how much risk are you willing to take on your investment side? So, to answer your question directly, what do we do for that? What does Saint Investment do for that? We've done syndications, we've done many different styles in the past of investing, polling our audience and polling our our investors in our investor group. What our group needs, with being a lot of business owners, right? Being a lot of, entrepreneurs, being a lot of people that are very hardworking, high hour outputs for their job and their career, most of them don't have time. So the number one thing that a lot of them need, some of them are much on the tail end of their careers or are retired. They want flexibility in this market and they want to beat inflation. So those are the two biggest things that we see. So what we did, we've worked with a lot of more flexible real estate instruments in the past. What we did is step into that space of what our investors requested from us and put together the Saint Income Fund. So that's our answer to what our investors need. It has a really short lockup period. It pays 8%, and then we return capital in 90 days or less. So, for some people that are like, hey, I need 12 or 15%, and I'm willing to wait 5, 7, 10 years, we refer them to guys like you. We say, look, that's not our model. If you need higher returns, we'll send you to great guys that are doing amazing things that will get you higher returns as long as you're okay with waiting 5 to 10 years. We'll send you to those guys. We are the flexibility option. We pay the set 8%, which is 60% more than 5%, right? So when you explain that, hey, 5 to 8 sounds close, it's not over a longer period of time. So we provide that option for our investors. Many, again, are at the tail end of their careers, much later in life. They don't want to wait 5 to 10 years. They're wealthy, and they might, some of them have concerns if they're going to be alive during that period of time, right? Others are very entrepreneurial, and they're saying, look, I need my money when I need it. I have to be able to access that capital. 90 days is a perfect window. So that's what we provide. And that's the space that we confidently step in, is more of just the flexible, consistent income space. Whereas there's other groups that exist in the growth phase of real estate and offer higher returns. So it's kind of a different category that we have kind of confidently stepped into as a leader.
Yeah, I love that. So yeah, we just talked about, inflation, how it can impact your investments, and there's a ton of different alternatives, and it really comes down to your risk and return profile, right? How much risk are you willing to take? And that goes into the sponsor, the type of asset, the length that you're holding that period, so or that investment rather. So we'll dive into the fixed income in just a sec. I want to kind of take a step back and focus again on the kind of relationship between real estate and inflation, right? When you talk about inflation and goods getting more expensive, kind of the natural assumption is, okay, well, that must hurt all investments across the board pretty equally, right? The cost of goods is going to go up across the board, pretty uniform. But one of the great things about, real estate and specifically multifamily is that you can reset those leases every 6, 9, 12 months. So even if, yes, your expenses for, on a property level might be getting more expensive, you can meet and kind of match the market on a much quicker time frame than some longer term investments like retail or like office, where even if you have the cost of goods rising, your rent across the board might stay flat for that 5 to 10 year period. And Nick, I kind of love that point that you just touched on, where real estate in general is seen as somewhat pretty illiquid, right? Your capital is being held for 5, 7, 10 years. And there's different structures of how you do it, but typically you're not looking for a return in 90 days, let alone, a full year. So the ability to kind of redeploy your capital, if you are getting it back in 90 days, is extremely powerful, especially in times of high inflation. So let's dive into kind of fixed income investing, because it might be a brand new topic for some of them, for some listeners. And I want to kind of dive into the nuances of what is it as kind of a general concept, and then how are you evaluating that risk and return profile, and how does it vary from kind of different investments altogether?
Sure. And so there's a lot of amazing considerations here for the investor. Again, during inflation, which is what we're in today, our bet is it's going to be a long-term. There's only so many investment options. You're thinking of growth, which is a little bit longer term. You're thinking of income, which is what we're dealing with. So on the income side, what we're evaluating is the most boring, consistent, sexy assets of all time, right? That's it. So we are looking for things that have been paying, markets that are already stabilized. We don't need a huge jump in our return profile to deliver. We don't want that, as a matter of fact. So we're looking at core markets with extremely developed fundamentals. And then, by the way, we've been doing this for a couple decades. So we're very dialed in on buying those assets just a tad below market, right? So I love multifamily. Multifamily has some of the most developed asset management, operators, strategies, right? We don't play as much in multifamily ourselves because it's such, there's so many amazing operators. I'll say that there's the highest tier of multifamily we have the most respect for. Well, sometimes we'll co-invest with amazing asset managers and investors, but really on the hard asset side, we play primarily in industrial in very specific markets. And the reason for that is industrial allows us very slow moving consistency, because industrial trends and shipping trends, we read shipping data every single month. We read ports, what kind of volume of inputs and output, or imports and exports into ports. We're tracking all this. That's why geopolitics is a big deal to us, because we invest in industrial, which is very dependent on that. So we're primarily industrial on the hard asset side, which we're very bullish on in a couple markets. And then on the other side that gives us the liquidity is we buy a lot of mortgages throughout the US. So all domestic, we don't do international mortgages. And mortgages, your return's pretty much built into the mortgage, right? So all the hardest work of underwriting is on the upfront side of that, right? So on the back end side, we can share statistics like we're almost 97% on our successful payments on a monthly basis. Our average mortgage is around $400,000. So we're not buying the low tier, right? Nationwide, $400,000 is a pretty high price for many average markets. We don't buy rural, we don't buy urban, right? We buy suburban only. So these are consistent, stabilized markets where we as Saint are not looking to make 30%. We're looking to make 10 to 12% on any individual investment so that we can make a few bucks because we have bills to pay, we got payroll, et cetera. And then we return that 8% to our investors stably, with stability, with confidence, just knowing that we have the most conservative assets, because our job is to produce income and to pay income and to get money back when they need it. So we are only looking for stability on that side. On the growth side, there are other factors when you're trying to return a higher return. but because it's stabilized, we're only our number one metric is stability.
Yep. It's actually a pretty timely discussion because I've had, a lot of discussions with investors who are kind of on the prowl for this next kind of grouping of deals that are going to hit the market. And, a lot of them are saying, hey, there's a bunch of kind of these deals that have a floating rate product on it that, have these bridge loans. And, there's a lot of consensus that when they hit the market, there's going to be these fire sales of distressed deals that, might not be meeting their debt service, or essentially creative ways to take over debt payments, take over mortgages. But a lot of the investors I'm speaking with are like, hey, I know multifamily, I know real estate, I know nothing about kind of the banking, financing side of things outside of just placing that debt on a property that I know how to well run kind of operationally, right? So what do you look for on the mortgage side of things when you are taking these mortgages over outside of just the market? What kind of risk analysis are you doing on the property or on the deal itself?
So this is a fantastic question, and I love it because there's so many aspects to in debt investing, especially real estate. You guys do big deals, you do big properties. So the higher level you go with asset prices and asset values and asset quality, really, the more institutions and opportunities you have to bring creative financing. So we're actually very conservative and we're very boring. So I'd like to say we have this master planned approach. Most of our business models are like 2 sentences so that we can always explain them to our investors and be like, guys, it's really hard to mess up simple business plans, right? Yeah. So what we do is look for very conservative things, very low LTV. Our LTV is usually around almost 40%, around 60%. So we have a 40% cushion, which if you look at the number one metric for deals falling apart is 2008, right? So if you look at the worst of the worst, which is like Vegas is one of them, the market was down somewhere between 35%, right around there, which was devastating. Obviously, other market segments even more. As a buyer during that period of time, we were buying stuff 50, 60% off, right? That's insane, right? Again, below replacement costs. But we're looking for the most conservative things. Low LTV. We are looking for owner occupied so that someone has a big problem if they don't pay their loan, right? They're losing either their home or their business location, building, et cetera. Like, these are important things to people. We never go through foreclosure. We usually sell the loan off at that point and let a different group do that. But again, because we buy so conservatively, and because the rate that we bought was so low, most of our mortgages around the 4 or 5% range, then if you're thinking that through, why would someone not pay on that if mortgages are at 6 or 7% today for many markets, right? So if you're at 4%, you actually have a cushion of safety, because if they go back out to the market, they can't get what they have now. So people can't wait to pay their mortgages. I think that's majorly missed in the media, that people are like 97% in most portfolios paying their mortgages on time without issue. So we're looking for conservatism across the board on the debt side. And then on the hard asset side, we're looking for things that have been consistent. We're not building anything. We've done development. We've done entitlement. We're very familiar with that. In the past, we bought environmental distress properties. We're very, very understanding of that. But we don't do that in the income fund. It's all just stabilized properties, usually owner occupied as well. That the owner selling it wants to lease the building back, right? So that they know the building, that they care about it. You're handshaking with someone that is going to be your tenant many times. So that's really our criteria: owner occupied, low LTV, very conservative, a history of performance. We're not going into there guessing or hoping. Good FICOs for the debt side, property values that are not at the lowest tier. They're about middle income or upper slightly income. That's what we're looking for. People that will be able to pay their bills over a long period of time, and assets that will continue to perform for, decades is really what we're looking at.
Yeah. It sounds very similar to what Viking's doing, right? Kind of taking a risk adjusted conservative approach where you have a demographic that can, afford, higher premiums. They can afford kind of nicer quality things. They can meet their debt service. So it sounds like that's very much in alignment where, you have such a breadth of investments that you could do in the fixed income space that you're really tearing down and say, hey, this is the conservative approach that we're taking, that, we're not dealing with all the kind of high risk, potentially high yield investments. we're just kind of sticking with our course of, hey, here's a conservative approach, a conservative risk profile, and you can get your capital back in a short time period. Does that sound right?
Exactly right. Exactly right.
I love that. Love that. So kind of walk me through the process. If, you had a high income earner who was working 60, 80 hours, potentially even 100 hours a week, they don't have a ton of time. If they want to get, started with fixed income investing, what are kind of the initial steps? Are they the ones going out there selecting the bonds and the ETFs themselves? Are they working with a financial group? What's kind of the easiest kind of low risk path to getting started?
Yeah, so absolutely. The number one thing that we're looking for on our side is to make sure that somebody has a balance, right? And again, we're not financial planners. I don't want to ever say that without that being the case. We're not financial planners, but I get asked by investors like, hey, Nick, what's your personal opinion? How do you balance your portfolio, right? And I go, look, I'm an open book. If I have hundreds of YouTube videos telling you exactly what I do, I am wide open with all of this. So I think it's a balance. So again, when someone says like, well, should I be going for a 12 to 15% return, or should I be going for fixed income? My answer is always yes. It's both, right? Like that's the answer. If you ask a financial planner, you say, what should I be doing? What's the game plan? And they go, oh, well, you should have this percent in stocks and this percent in bonds, right? That's kind of like the standard issue. And all they're really saying is you should have a balance of stocks for growth, and you should have a balance of bonds for the fixed income stability side, right? So while I think you should be adjusting those percentages in different market environments, I'm just gauging to make sure that we're a good fit for the investor and they're a good fit for us. So when there's certain people that even if they're accredited are kind of paycheck to paycheck, month to month, and it's just not a good balance, I'm telling them, hey, look, I think maybe, you need to consider what is the best option for you at this time period. So again, we're consistently the best fit for people that want the flexibility, typically that run businesses, that are, either high net worth, high executives in a business that's very established and on track, or more the entrepreneurial side that has a lumpy income of some kind. I go, we provide that stream of income that balances that out. And then people at the other end of the spectrum that are maybe at the tail end of their career or want more access to their capital when they need it, that's an amazing fit. The third category that we talked about earlier of growth investing, income investing, the third, which I hesitate to say right now in this market environment, but debt can be a very valuable tool in many market environments. Now it's like, I want to say like an expert category of investing, but the reality is if we're dealing with high inflation, which we are, then the reality is you're inflating your way out of debt. Right. So if you take $100,000 loan and inflation is 5% a year, then you are losing on your, I want to make sure I'm wording this correctly. That loan value is basically devaluing 5% a year by inflation, chiseling away at the value of that 100,000 that you owe back. Right. So for me, at certain times in different market environments, I've taken on personal loans to invest in fixed income investments, because the return that I was getting from the fixed income was higher than the income or than the interest rate that I was incurring on the personal loan. That's just arbitrage, right? So that would be the third category that I'd say: growth, income investing, and debt investing. That's what I have done successfully in the past. Again, it's more of an expert approach, but it's interesting to see if you're making this much on this side, why not put that towards something that's making even more and to offset your payments on that? It's like that arbitrage approach.
Yeah. I mean, especially during periods of high inflation when the dollar's being devalued, why not diversify and kind of shuffle your money around to make it the most optimal use for you, right?
Sure. Absolutely.
Quick question for you, just out of curiosity. So, typically in most real estate deals and how they're structured, you have what's called a pref payment, where you get kind of a certain amount to investors, maybe 7, maybe 8%, throughout the life of the deal. Oftentimes during, value add projects that, Viking does, for example, when we're instituting the value add, we're doing a bunch of renovations, we're capturing those premiums, we might not hit that 7-8% year one of the deal. And what happens is that it's accrued and it's paid out over the life of the deal. But I'm curious on the fixed income side of things, is that similar where if, let's say, investors are guaranteed a 5% return. If they're only getting 3 or 4% in kind of that time frame? Are they made up whole on the back end, or how does that work exactly?
So that's a great question, and one we get very consistently. So again, with the growth model, there's this understanding where you're saying, hey, we're all in this together, right? If you don't make it on the front end, you're going to make it on the back end. And that's really part of that model, right? Higher returns. There's some, different risk profiles on certain things. And there's definitely a different payment schedule on certain things, depending on what the performance of that deal is. That does not exist with the income approach, right? So for an income fund, we have zero, we don't do that. There's no make it up on the backside. We always make our preferred payment, our distribution. So our track record is, I think we just passed 120 something months of so over 10 years, we have not missed a distribution to investors at any point in time. Again, we're very conservative, right? But when we say the stamp of approval that Saint is going to pay our bills, we point to a decade of that performance showing that that's the case. So on the income side, if you're investing in income, instruments or income investments or income securities or whatever investment model with income being the goal, it's basically like, you can never miss that payment, because that's one of your guarantees is flexibility. No, excuse me. There are no guarantees. There's no investment guarantees, but that's one of your things you're always striving 100%. I can say we've never missed a decade, a payment in a decade, but on the flip side, we just had a pandemic, a global pandemic. So we don't always know what's around the corner.
Yeah, I love that. I love that promise. And it's kind of similar to what we consider Class A in some of our investments, where it's a 10%, cash flow payment every year. It's not, you don't have to take part in kind of the front end or the back end. It's kind of that almost a fixed income approach, but you're putting it within a larger kind of real estate syndication.
Yeah, and you know what the different models are? The different models usually fill in the gaps for each other. So that's kind of what I consistently, like to say as far as that goes. The number one thing though is when you're investing in real estate, right? You're getting out of the stock market, right? Because the stock market, the reality is for real estate, we can sit and talk like this, Nathan, right? I talk to investors every week. My team, my investor success team talks to investors every week. And we're always, dozens and dozens and dozens of calls. So it's direct. We're hearing what they need. We're giving them what they need. We're staying close to that. We have webinars where we answer Q&A on the fly so that they get that interaction. But you look at a company on the S&P 500, these might be multinational, multi-billion dollar companies, multi-language, multi-HQ, all those things. Do you think that they care about any single investor, right? And that's not a disparaging the stock market. I invest in the stock market a little bit, but it's the reality of that when we're dealing with inflation, when we're dealing with concerns about the future of different economies, different environments, I don't want to be so distanced from the guys making decisions, right? Mm-hmm. So just that close proximity, being able to ask questions to the Viking team or the Saint team, and knowing exactly what they're doing and why they're making decisions, answering questions on the fly, that's a huge benefit. And I invest with, our quote unquote competitors. I invest with almost all of them, right? Because they provide good returns and good service. So it's not, it's cooperative in that sense too, because I trust them.
Yep. And I love that hybrid approach too, because you're taking that fixed income investment, which traditionally could be bonds, municipal bonds, a lot of kind of government entity kind of organizations, and bringing it to the real estate side and really kind of servicing those investors that are saying, hey, I want, a fixed income guaranteed, quote unquote guaranteed payment, and I don't want to hold it for 3 to 5 years. Like that fixed income approach is a perfect, puzzle piece for them to really kind of have the benefits of investing in real estate, the benefits of investing short-term, and the benefit of kind of that fixed income approach. So, absolutely. With that, any kind of parting words of wisdom that, our listeners could take for actionable items to be creative, to really kind of be able to recognize what's ahead of us and potentially that decade long of inflation, and how to really set themselves up for success, knowing that, every day our bank accounts and our pocketbooks are getting slowly chipped away at by that inflation?
Yeah, I would say the absolute number one thing is to crush it at what you're doing, right? That was a lesson that took me too long to learn. And really, it took me a huge period of time of evaluating finances and evaluating my own financial standing to understand that I really needed to go all in. So if someone is in their respective field, whether they're a professional, an attorney, a doctor, a medical professional, an entrepreneur, whatever they're doing, in my experience, I've always made more money focusing and investing on the side. That was literally what brought me all my success. I can't say anything more about that, there's nothing I believe in more than that. So with that said, I've always made more money focusing and then investing to get those returns. I think with investing during inflationary times today, that's more important than ever. So sitting money in the bank is very difficult right now. For me, it's painful. It's literally painful, right? But so that's the best advice I can give the audience is check that out. If you want to learn more about inflation and what we see ahead at Saint, I'll send you guys the link, Nathan, to our webinar on that and break that down. And then we always have a ton of really good information on our resources section at the Saint site. We're always going through new topics, new webinars, etc. So I'm always happy to answer questions or help people get some of that information as well.
I love it. Love it. I appreciate your time, Nick. I appreciate your expertise and kind of your thoughts on what lies ahead. It's going to be an interesting time, but if you're well-versed, you're creative, you're scrappy, and you're taking a good look at your financials, I don't think it's anything that, you, me, our investors, your listeners can't stomach for the foreseeable future.
I agree, man. Hey, it's been really, really good chatting with you, Nathan. Always great catching up with you, and I look forward to talking to you soon.
Absolutely, Nick. Take care.
Yep.